We create ideas and micros from really 2 or 3 major sources. We start by shrinking the universe down to businesses that generate cash flow. So that reduces the universe down materially to maybe a third of the actual universe size. We then look for criteria around valuation and balance sheets and quality of business. So they're not necessarily easy things to screen for, but they're sort of criteria we look for in businesses that make up our portfolio. So it has to have good valuation, generate cash flow, generate earnings, and be a reasonable valuation. And if it ticks those boxes, we'll look to go there. Other sources are things like lateral ideas. You might come across an idea in a larger space, and then drill down to microcaps. And go laterally. So look at one idea and say mining services, and then go down the spectrum and see 3 or 4 names in the micro space that are really attractive or really cheap or really interesting for a bunch of reasons. We run screens on as I mentioned, earnings generation, free cash flow, balance sheet, valuation, and that yields a small number of shares to go and hunt down. And then sometimes we run this thing called a contrarian screen, where we look at going against the crowd. So whatever has the stocks have the most negative recommendations, we might consider going and looking at those and seeing whether there's any interesting opportunities there. Recently, when I say recently, sort of 9 months ago, Monadelphous was a company that screened very well from a cash flow, earnings, balance sheet point of view, and also was widely disliked amongst the sell-side community. We saw a business that was well run, great management team, as I said, good cash flow, good balance sheet, good valuation, that we thought had been well truly oversold. Like, in other words, that the mining cycle had been more than priced into the share price, and so that yielded a really good outcome for us. We bought those shares and around $6. They're now close to $8.50 or something. So there's been a good return in 9 months. It's not the only idea generation tool. It's just one of many we use, and it just kicks up some interesting ideas to go and chase down every now and then. Now Gibson was in its heyday a very well capitalized iron ore stock in the small cap space. It was dependent on 1 or 2 mines that saw a downturn. So the share price got hit aggressively on the iron ore price because they're a reasonably high cost producer. Market cap got washed out. It has a mine on I think it's called Coolin Island. Anyway, it had a mine that was basically had a massive seawall that flooded or broke open, and the mine was underwater and got flooded by the seawall opening up, so they had to cease production at the mine. That, on top of the fact that iron ore price got hit very hard, on the top of the fact that it had a Chinese majority owner was a Chinese corporation, meant that people thought the shares were terrible investment opportunities, so it got sold down very aggressively. To one point, it was trading a market cap of $200 million with $300 million plus of net cash on the balance sheet. It had several potential upsides. It had the opportunity to buy back shares, to pay dividend, or actually was suing. It was claiming for its insurance company for some money to repair the seawall, basically, and or business continuity. So it had 2 options to get money back from its insurance company. Which it subsequently did, and I think the sum was around $50-60 million, quite a decent chunk of money. So that combined with cash meant that it was trading at an even bigger discount to cash flow, and so the shares had a massive re-rating on the back of that. So we bought it because it gave us opportunity to get exposure to iron ore should the iron ore price recover. Plus, it was it's a fundamentally very cheap investment, right? It's trading at sort of 35% discount to net cash backing, and we thought the management team would do a reasonable job to preserve that cash.